Yeah, hello friends. So welcome to our channel again. So today we'll be going to have a look at how to do an adjustment for an bull call spread if our trade goes against us. Okay. So and this is for an educational purpose. So please do your own analysis before doing a real trade based on this adjustments. Okay. So yeah, friends. So bull call spreads. Okay, so bull call spread is like it's initiated if you are bullish on any of the stocks. Okay, so so how to initiate an bull call spread is like buy one lower strike call option and sell one higher strike call options. So this is called the bull call spread. So bull call spread will always comes with a limited risk and limited profit. Okay, so max loss will happen to this bull call spread is like a whatever the debit we have paid for buying an option and minus whatever the credit we got by selling in options. Okay, so this is our max loss which is going to happen, and max profit is like difference between the strike price minus the max loss value. So this will be the maximum profit which we are going to. So the difference between the strike price is like the buy price call option and the selling call option. So whatever the difference between this minus the max loss value, right? So that will be our maximum profit which we can get from our bull call spread. So bull call spread, so we are assuming that the market will go up, but if in certain cases if the market doesn't move up, then we'll be start losing, right? So we are going to have a look at how to do the adjustment for those trades. So bull call adjustment 1. So if the stock moves up too slowly, then we can roll. So let's assume that the stock is not moving very much good and it started moving very slowly. Okay, so in that case what we have to do is we should roll our short call option into a nearby weak expiry than our long call, which means that we are creating an bull call calendar spread in these adjustments. So for example, like initially in our initial position we are buying the 10,000 call option and we are selling the 10,200 call option at the 25th June monthly expiry options. Okay, so after initiating this trade the market is not moving much higher and it's having a slow movement. So in that case we need to roll, means like we need to close our 10,200 call option of the monthly contract and we need to initiate the same sell from our weekly expiry. Okay, which is like 11th June, which is in coming week expiry. Okay, so by doing this adjustment our sold option of the 10,200 from the current week expiry will expire worthless soon due to time decay and we can get profit soon. And you need to close your trade on 11th June even if the market starts moving up about 10,100 or whatever it is till 10,200 will be in a profit. So 10,200 call option will expire worthless and we'll be getting the profit from that, and also we'll be getting some profit from 10,000 call option as well as the market is moving slowly on the upper side. So this is an bull call strategies adjustment 1, and now we are going to have a look at the bull calls adjustment 2. So in this, if stock price moves towards downside, then your trade will start losing money. So bull calls spread, we need our options, our underlying stocks to move upside, but in this case if the stocks starts moving down, then we'll be starting to lose our money. So now you can close your sold option and you can sell your call below your long options. So in this case we'll be converting our bull call spread into an bear call spreads. Okay, so which means that for example we are having a 10,000 call option buy and 10,200 call option sell, then we need to close our 10,200 call option and we need to initiate the sell of 9,900 call option so that we can come out of the loss if the stock tends to move down further. So means like in this case we'll be getting more premium than our 10,000 call option by selling the 9,900. Okay, so you'll be in a profit if the stock don't move above 9,900 in this case. Okay, so then bull call options strategies adjustment number 3. So in this case if the stock starts moving down, then we will be getting losses. So we can close our buy option and initiate the same bull call spread by moving our trade 100 or 200 points lower. So which means that in this case we are converting our trade as a bull call spread into an bull call ladder strategy. So for example, initial position is we will be having a 10,000 call option buy and 10,200 call option sell, and in this case if the stock starts moving down, then what we are going to do is we'll be closing out 10,000 call option alone and we'll be keeping the 10,200 as it is. We are not going to touch the 10,200 call option sell. Okay, and after that we'll be initiating the new trade as buying the 9,900 call option and selling the 10,000 call option. So which means that we are moving down our bull call spread to 100 points. Okay, so in this case our trade will be in profit profit till our profit will be on the profit till downsides, and if the profit even if it is moving too much upsides, then we'll be going to get a loss about 10,300 level. So if the stock price starts moving above that level, then anyhow we'll be in a profit in our bull call spread, which we initiated at 9,800 CE and 10,000 CE. Okay, so in this case we should close our entire trade and move out of the trade with a good profit. Okay, so here I made some mistake in while preparing this PPT. So here we can sell 9,000, we need to sell 9,800 call option, assuming that the stock Nifty moved below this 9,800. If the stock is not moving below 9,800, it's staying at 9,900, then you can initiate 9,900 call option and sell 10,000 call option. Okay, bull calls adjustment number 4. So this is a simple adjustment strategy where we are going to book our loss and come out of the trade. If the stock starts moving downside, then we will be closing our trade without doing any adjustment and will be coming out without waiting till the maximum loss. So let's assume that we will be having a maximum loss of 2,000, and if after some certain down move, if your trade has been moved into an 1,000 rupees loss, then we can come out by booking that 1,000 as our loss. Okay, so by this case we will be minimizing our maximum loss. Okay, so thanks for watching, friends. So please do subscribe to our channel and click on the bell icon so that you'll be getting a notification whenever we upload new videos. So this is an educational video, so our motto is like to train people about the option strategies adjustment. So thanks for watching, friends.